سلام به همگی. امیدوارم که همگی خوب باشن. سال نو مبارک. من علیرضا هدایتی هستم. امیدوارم از این برنامه سیریزی که ما داریم روی زوم انجام میدیم همگی خوششون بیاد و واسه یه بنفیتی برای همه باشه. ما دوست داریم تاپیک های اینترستینگ تاپیک های پیک کنیم، سلکت کنیم که مردم واقعا بتونن یه بنفیتی ازش داشته باشن. I'm going to speak English. Welcome everyone. Thank you for being with us tonight, this evening. I want to thank Dr. Gandevani, obviously, for taking the time to be here with us. I want to thank you guys for taking the time to be with us, enjoying this series with us, Zoom series that IAS is going to be having in every few weeks, every few Sundays, at least 2 Sundays a month in the next 3 months. So the next one will be on April 25th with Ambassador Limbert, John Limbert. So you will receive information about that as well. Without further ado, I'd like to introduce one of Iranian American Society's Board of Directors, Mr. Majid Khosrowshahi, to introduce Dr. Gandevani and formally welcome him. Thank you, everyone, for being with us.
Thank you, Mr. Hedayati, for introduction. I also welcome, ladies and gentlemen, you to this special meeting. And the reason I'm mentioning this special meeting because we have the honor of joining with us a special and distinguished author, professor, and more importantly, a dear long-term friend of mine and a mentor. Since my personal relationship and friendship goes back so many years with Mr. Gandevani, Dr. Gandevani, it is really my humble opinion that Dr. Gandevani is everything one could look for in a good mentor. Now, it is my honor to share a short biography of Dr. Gandevani's credentials and his achievements with yourselves. Dr. Gandevani, MBA, Ph.D., is an author, professor, a senior portfolio manager. He is a graduate finance professor at Harvard University and senior portfolio manager with Maloney Securities, known as RBC Capital. Recently, he has served as the program chair for the Master of Science in Finance in New England College of Business and Finance for 7 years. He has extensive experience in academia and industry in the field of finance and risk management. Dr. Gandevani spent 20 years of his career as a trader and hedge fund manager, specializing in quant systems, macro strategies, and the utilization of different asset classes to maximize performance. His proprietary technique and trading system, including the trading personality profile known as TPP, helps securities traders identify their performance style and work toward their strengths. His academic background encompasses more than 15 years of on-ground actually, and online teaching experiences with universities across the country. Dr. Gandevani has developed a new program, Master of Science and Risk Management and Insurance, and 4 new concentrations for the Master of Science in Finance for the New England College and Business and Finance in Boston. I can go on in terms of the credentials of dear friend Dr. Gandevani, but I think without further ado, please let's welcome Dr. Ned Gandevani. Thank you.
متشکر هستم. من فقط واقعا تشکر می‌کنم آقای خسروشاهی و آقای هدایتی از این دعوت. من انگلیسیم زیاد خوب نیست، ولی به نظر میاد که بهتر بتونم نکات فایننس رو به انگلیسی بیان کنم. اگر اجازه بدید من انگلیسی صحبت کنم. I want to express my gratitude for Mr. Hedayati and of course my dear friend Mr. Khosrowshahi for this kind invitation. I'm delighted to be here this evening. And I guess I will be discussing and hoping that to provide you some information so you are able to make better decisions, at least in your finance and investment portfolios. At the end of my discussions, I will be gladly open the floor for any questions that you may have, and I will do my best to entertain them. So, as usual, I would like just to check. I'm sure everybody's able to see me and hear my voice, but if you are able to hear me and see my video, give us indications, so I should be okay to start. Wonderful, excellent. So I do have a PowerPoint here that I would like to present to you. Of course, as you have noticed, the title of the PowerPoint is a little bit different. So the title is How to Hedge Your Portfolio Against Market Volatility compared to what it has been published as a rising inflation rate. Although they go both hand in hand, but I thought this general topic would be more beneficial to all. So without further ado, let me present my 2 cents, and I hope that with your contribution and your questions, we'll be able to extend the quality of the presentation tonight. So we are facing with rather very exciting time. The current investment environment is absolutely amazing. The main question that I usually ask of my colleagues, and then we are in discussions, are we in a bubblicious stock market? I call it bubblicious because some may argue that we are in a bubble, and at the same time we are enjoying the exciting ride that we are having now. So it's like a delicious flavor of rising the stock market. So I'm not sure if we are in a bubble, but certainly, I can assure you that we have been enjoying the constant rise, at least since 2009 up to now. Nevertheless, we will go over some factors and some variables that should give us some indication and help us to ascertain the current investment environment for better decision makings. So we'll be looking at current stock market high valuations. Where are we compared to the norm, compared to the average? Are we overpriced? Are we underpriced? And what are the indications for being overpriced, for that matter? And another important factor, which we call it fundamental factor and variable, is basically the size of the US money supply. So I will provide some information to it. It will help us to decipher the ballooning of the US money supply. And lastly, we will consider the rising interest rate. So let's look at here at the stock market. This, as you see, is a chart of S&P 500 index. So as many of you may know, the S&P 500, or simply the S&P, is a stock market index that measures the stock performance of 500 large companies listed on the stock exchanges in the US. It goes back all the way to before 2017, but I thought, that would be interesting to note. Just last Friday, in April 9, we made another new high. It seems that constantly we are breaking new highs. Just over 1 year, going back to March 23, 2020, just at the beginning or when the inflection point came to the pandemic. Since March 23rd, 2022, up to last Friday, we had more than 84% return. That is just amazing. Just a little bit over 1 year, 84%. Is it for real? Can we continue this upbeat move? Of course, we hope that we do so, but if we don't, what kind of measurements, what kind of tools we can utilize to protect our hard-earned investment dollars? What can we do to hedge our portfolio for possible corrections or high bond volatility and high bond rising inflation rates. Let's look a little bit further back. Since 2009, which we made a low of on the S&P index, 2,237 on March 23rd. 735 on February 1st of 2009. As of Friday, we had a return of 461%, close to 462%. More than 4 times we were able to have a better return on our investment. That is another wonderful news. But as I stated earlier, is it possible for us to continue? Is it possible to consider that all good things about the stock market we are experiencing could last forever? Or at least we can continue for another, 10, 12 years? That would be very lovely. But if not so, what do we do? If not, how do we protect our portfolios? We can never predict what will happen tomorrow. None of us. If anybody claims they have crystal ball, then come to me. I do have a Brooklyn Bridge to sell to you. The fact of the matter is, despite all these strong fundamentals, we never ever could have predicted the pandemic corrections we had last year. How about 2008, the beginning of Great Recession? How could it be the Lehman Brothers, an established institution in the financial market, being there for more than 100 years, could be the start point of a financial collapse in 2008? The reality is that, or to be realistic, there is no way for us to foresee what would happen tomorrow, Monday, or next week, or next month. A prudent method would be for us to utilize different tools available to us so we are able to protect our hard-earned investment returns. So it's very clear that S&P 500 as a major indication for the stock market performance is sitting at all-time high. There are different ways that we can basically value stocks. Looking at fundamental analysis, we identify future payouts in form of dividends, free cash flow to equity or free cash flow to firm, or earnings. We apply different methodology, including DDM, dividend discount model, DCF, discounted cash flow, or residual income model to identify the intrinsic value of a stock, or in the aggregate the stock market, so we can compare and contrast with market price. The intrinsic value with the real value is less than market value or market price. We typically issue a sell signal. That means the stock price is overpriced. We hope to buy it back at lower levels. Conversely, if intrinsic value is greater than market value, we issue a buy signal. That means for whatever reason, market is unable to appreciate the value of the stocks or the companies for that matter. Therefore, we rush to buy it. And sometimes when market value is about the same as intrinsic value, you simply have a hold signal. If you don't have it, don't buy. If you have it in your portfolio, keep it. Another method we use, which is based on comparative analysis, is market multiples. The famous one is PE ratio. PE ratio simply states that the price of a stock divided by earnings of stock. In other words, if the PE ratio of a stock is 17, that means for every $1 earnings, we are willing to pay $17 in the future. Okay, with that perspective, let's look at S&P 500 PE ratios. This is as of Friday, April 9. The PE ratio for the market, 42. For every $1 earnings, you as investor are willing to pay $42. Would you do it? If I have a business and I tell you that next year I will create $1 earnings, would you buy my business for $42? How would you justify that? More important, looking at the historical performance, the mean or the average of PE S&P 500 has been close to 16. The median, which is a better measure, is about 15. As you can see, back in December 1917, the minimum was 5.3, and back in May 2009, max was 123. So at least one could argue, based on earnings, stock market is sitting at very expensive price. Some may argue further that it may look foolish for someone to pay $42 for every $1 future earnings. Let's not go into the earnings. As you may know, or some of you may know, earnings is a GAAP calculated number. That means basically a lot of legal manipulations have been and could be implemented to generate higher earnings, basically by manipulating accounting accrual basis. But let's just not forget about them, not discuss them for now. So one variable I want you to pay close attention is the PE ratio, how far it can go up. Does it make sense for us to pay $42 per $1 earnings in future? Another variable that the same variable, but another indication, which basically indicates the valuation levels that currently we are dealing with. I have listed here about 21 major industries in the US. For example, the first one is semiconductor, which has 70 firms within that industry. The average current PE for semiconductors, 1,291. I repeat, 1,291. Meaning, investors are willing to pay $1,000 or close to $1,300 for every $1 earnings projected in the future, anticipated in the future. Real estate, another major industry in the US economy, has 61 publicly traded firms. The PE ratio currently is 1,200. Entertainment, 908. Household products, 592. I really want you to think, as I'm reading these numbers, how logical would it sound to you? What decision would you make if you were at a position to purchase a business based on their expected or projected earnings in the future, that you are willing to pay, say, $1,200 for every $1 earnings? You have environmental and waste services, 538 with 86 firms. Healthcare products, 265 publicly traded companies, PE ratio of 331. And the list goes on all the way down to semiconductor equipments with 40 firms, current PE of 109. How about if I present you the total market? Roughly about 7,582 publicly traded stocks available. The average current PE is 110. The average PE ratio for S&P was 42. For 500 large companies traded in the US. Total market, which encompasses 7,582 firms, the current PE is 110. Now you tell me, is market overpriced? Should I be concerned? Should I expect for market to move higher and keep on making new highs? Is it possible for us to go another year, 2 years, 3 years, within just more than few days, more than 1 year, I have 86% return? Is it logical for me to expect that good things will continue to produce amazing earnings in the future? You be the judge. By the way, as a disclosure, because I have several licenses, and as Mr. Khosrowshahian, kindly introduced me, I'm a senior portfolio manager with RBC Royal Bank of Canada, one of the largest banks in the US and international. And so I am not presenting, or I'm not giving you any advice. If you wish, to attain any kind of advice, please see your financial advisor or gladly email me, and I will be happy to help you as much as I can. So I'm just providing this information as a pure disclosure for your own educational information. I am not stating that market is overpriced, therefore you should sell your portfolio. I am not asserting that market is underpriced, therefore you should buy more stocks. I am simply presenting some facts, providing some additional information so you can make better decisions with the help of your financial advisors, or privately feel free to contact me. Because anytime we discuss, recommending anything, you need to identify your risk tolerance. You need to assert your investment goals, and accordingly put together, construct a portfolio which matches what you're seeking for. Nevertheless, so you are talking about PE of the general market, which has 7,582 stocks, is 110. And if I want to include market without financials, which we have only 6,253, still PE is very high, more than 100. All right, so let's look at another angle on the PE ratios. Let's look at the S&P 500 stock by highest PE ratio. I have identified some stocks for you. Booking Holdings, Inc., with a PE ratio of 1,977. SBA Communications, 1,298. TJX, 932. ServiceNow, an important high-tech company, 906. Gilead Sciences, your pharma company, 669. Fidelity National Information, 595. And then you have Ross Stores, a discounted department store of 533. AES, 431. TE Connectivity, 372. And Kinder Morgan, 353. So these are some of the selected companies for your information again. I'm not sure if you heard that in the past few weeks, we have been dealing with some crazy stuff in the market. Maybe some of you might have heard about GameStop. We simply, a company with a value of $5 or $6 went up to more than $407 and dropped back again. But right now is about 130 up and down. So what is the current investment environment? Now, I thought also, let me show you some of the, at least 5, because there is a discussion and a proposition that the general market may not be overpriced. However, we could easily identify 5 major sectors that seems to be in a bubble. That means if you try to protect yourself against these sectors, either not to invest, or if you have invested already, then basically take some profit and tame it, the total holdings you have in each sector, you might be safe. I'm not sure. I will leave it up to you. So first sector is clean energy. Anything related to ESG or environmental, social, and corporate governance has absolutely seen an amazing boom, especially past year or two. To give indication of this boom, that if you look at one of the top holdings in this environment or in this sector is iShares Clean Energy ETF. So iShares Clean Energy ETF basically is all about clean energy and all about ESG. Since its pandemic low last year, this ETF has rallied as much as 324%. Just less than 1 year. The second sector that you may want to be cognizant of in your portfolio arrangement is solar energy. So the industry is expected to significantly, of course, benefit from Biden's $2.2 trillion infrastructure bill. Solar stocks stage a strong rebound after its pandemic low, with the Invesco Solar ETF has rallied 496% in less than a year. Is it wise for you to continue investing in this sector? Wouldn't it be a better choice if you trim some of your holdings and lock some of the profits you have by using proper protection, maybe put option or anything like that, which I will give you a little indication later on. But the fact is that solar energy is another or as one of the 5 highly valued sectors in the current market. The third one, EVs, electric vehicles. Investors are holding out but hoping for more gains as Biden's infrastructure bill, which includes $174 billion for EV industry. Of course, Tesla, right? The leader. EV stocks have rallied by as much as 178% since its pandemic low last year. How do I know? By simply one of the major ETFs in this field, in this space, is iShares self-driving and electric vehicle. The fourth sector, cryptocurrencies, crypto assets, or digital assets. Of course, Bitcoin remains the most popular cryptocurrency. But there are thousands of other crypto assets. Many of them have seen amazing price appreciation due to Bitcoin popularity. Those crypto assets tend to move in tandem with Bitcoin. They have seen a more than 1,400% increase since last year's pandemic low. 1,400%. The total market value for cryptocurrency is estimated to be $2 trillion. Now, JP Morgan states that the cryptocurrency space is a potential bubble. And then, on top of that, they believe that cryptocurrency, or Bitcoin particularly, which currently is about $61,160, could move up to $130,000. The last, not the least, sector that seems, looks, and smells bubblicious is SPACs, special purpose acquisition company, or sometimes you might have heard blank check. The boom in SPACs over the past year has been unprecedented. As companies seeking to go public, this is much easier, faster, and less expensive way to go to public rather than going through IPOs. In the first quarter of 2021, SPACs raised more money than they did in the entirety of 2020. The first 3 months, or close to 4 months, they have raised more money, they have attracted more investors than the whole year in 2020. Some estimates even suggest that the current stable of SPACs have more than $1 trillion in buying power. So these are the 5 sectors. If you have stocks within these sectors in your portfolio, you may wish to be a little bit more careful. You may wish to reassess the valuations of these sectors. Another fundamental factors that we could look into to ascertain the current investment environment is US money supply, or M2. So we have different money supply measures. M2 is a measure of the money supply that includes cash, checking deposits, and easily convertible near money, anything that you can convert to cash. Now, money supply M2 in the US increased to $19 trillion in February from 19.669 trillion dollar in February from 19.395 trillion dollar in January 2021. Wow. It should be noted that the overall money supply has increased 22% in just 1 year. What does it mean? If there are more money, if there are more liquidity in the market, it may present higher inflation because more money, more cash available. Therefore, people or the more money is chasing products and services, which it causes prices to rise. Or you may also consider this: as long as Fed is pumping liquidity in the market doesn't have a choice but to go up. That means, yes, we may be overvalued. Yes, market could be expensive, but as long as the liquidity comes in and Fed is adamant to keep interest rate low, there is no way that investors could basically invest in real economy. They have to invest in financial economy or financial assets. Let's look back from 2009 to 2014. More than 95% or the main contributing factor for rising the stock price has been liquidity injected by Fed. Companies and corporations, they have access literally not only to cheap, sometimes close to zero money, zero expense capital. So what they would do? They were supposed to invest in CapEx. They were supposed to expand their operation, hire more people, help GDP to grow, not to get the stock at 2%. But they realize the risk investing in real economy, in expanding their CapEx, is very high. What do? They simply repurchase their own shares. By repurchasing their own shares, they shrink the supply of their stock, and the price, because of the demand, price rose. And you have rising prices. Who benefits the most? The CEOs of the companies, because they are compensated based on their stock price performance. So all this money printed, they're available for corporations to help them with the inflection of Great Recession. Since 2009 has been funneled to repurchasing their own shares, hence rising stock prices. Nothing to do with investing in real economy, nothing to do with expanding their operations, nothing to do with increasing their employment, or for that matter, paying better wages. Indeed, looking at from 2009 to 2014, you can see we have high rising earnings primarily by reducing the bottom line cost, not top line. So there are two ways for a company to increase their earnings. One is through investment, through expansion of their business, bringing new sales, selling or increasing their sales. We call it top line because that's the first line in the income statement. Sales and revenue. No, they did not do that. They utilized another method for increasing earnings by reducing bottom line. reducing their OPEX, operational expenses, by not increasing the salary, or basically asking employees to do more for less money, by cutting their benefits. Nevertheless, now we do have this. There are theories, of course, some may argue that increase in M2 may result in higher prices or inflation. The fact is that we haven't seen in the past, and simply money supply does not increase inflation. The velocity of money supply, the velocity of circulated money causes inflation. How fast we conduct transactions, how fast when I receive money, I go and buy something, and how fast producers they produce. Looking at PPI, looking at CPI, looking at GDP deflator, and looking at PCE that Fed utilizes to measure inflation, we haven't seen that much. As a matter of fact, Fed has been always worried that we may fall into deflation, not even disinflation, deflation. It's very hard to find someone to be jolly and happy and to get heart attack, right? The same thing. People argue that, some people argue that, look, when you have too much inflation, it's much easier for Fed to control and reduce the engine of the economy. But if the car is not moving, it's difficult to break the inertia and create momentum. When people, they get depressed, it's difficult to get them out of depression. The same thing applies to the overall market economy. Nevertheless, something that many of my colleagues, they worry and they consider it very seriously. And as a matter of fact, that could be one of the reasons that you see digital assets. I don't like to call them cryptocurrency because they're not currency. Crypto assets, digital assets, have been appreciating tremendously. Now let's look at long-term interest rates. So Fed's interest rate is unchanged until 2022. That's what Chairman Powell told us several times, not one time, constantly, every press conference they have. They reassure the market nothing will change, and basically federal Fed rates will stay between 0 to 0.25%. That means in the environment of a low interest rate, there is better opportunity. There is more potential for market to move up. However, the market moves up does not negate the volatility. Do you have the heart to stand the volatility? If market goes up 100, next day it goes down $50, can you accept that? High not. As a matter of fact, what happened when our baby boomers or people that were just about to retire at 2008, they realized their hard-earned retirement accounts were shrunk by 60%. Tomorrow, next day, next year, you have some emergency need for money. Hopefully it's a positive one. You have to finance a wedding, or for whatever reason, or God forbid if it's negative one, or you may decide to retire. How do you know where the stock market price will be next year, 2 years? Have you created proper protection means? So whenever you need this liquidity, you are able to convert and be able to capture the profits you have made. This is a message I want to make sure I'm able to convey this evening. Yes, stock price could keep on going higher and higher. I don't know how long, and I don't know what will happen tomorrow, next day. Especially if I need some liquidity, if I need to access my account, I just can't afford to see stock prices has gone against me. My suggestion would be identify proper means to protect your investment portfolio. Looking at basically, you can see interest rate went all the way and then start going down. Indeed, many on the street believe that we are facing with secular trend, downtrend that is, of interest rate. Well, look around, look at globally. Germany, when we have many of these sovereign nations are dealing with negative interest rate. In the past few years, we experienced nominal interest rate. In fact, right now, real interest rate is negative. What do I mean by that? Well, suppose you put $1,000 in your savings account. And let's be optimistic that your savings account is one of the best ever and gives you 1%. Okay? At the end of the year, you have 1% return. But the inflation rate running about 2.5%, that means the real interest rate that you're earning on your investment is minus 1.5%. In reality, by the end of the year, you have lost purchasing power of your investment by 1.5%. So, but what happens that interest rate could easily jump up, as we did. 10-year note moved up to 1.7, 1.8. We backed on about 1.5. Before we said that, okay, 1.5 is a borderline. As soon as it starts touching and going up above a 1.5 on 10-year note, you may not remember, but I remember very well because that's what I do, managing my portfolio. Market dropped, worrying about higher interest rate. Now, of course, market is a discounting mechanism. We were able to analyze and accept that it can go up to 2%. And it can go, meaning that we have already accepted, we have already discounted that. What happens if it goes above 2%? It can easily go up. When you have too much money floating around, there's a good possibility that we can see inflation pushing the interest rate higher. But what happens if you are wrong and for whatever reason tomorrow we see some corrections? The problem is that in a market corrections, when we lose money, it's difficult to make up. If I lose 30%, I have to make 42.9%, close to 43% return just to come to break even. And if I lose 50% of my capital, guess what happens? I have to make 100% return just to break even. Is it possible? Yes, it's possible. but how realistic it is. But we have had incidents that we lost 30%, 40%, 50%, 60%. Call it black swan or whatever you wish. The fact is that market volatility could basically, make us lose our hard-earned money. And I'm looking at clock. I know I have only 1 hour to go. I may go over time. I hope it's okay. But nevertheless, that means that it just emphasizes that you have to be careful with your investment. Now, how do I hedge my portfolios? There are several ways that I can protect my portfolio. One is portfolio diversification. Another one, basically understanding, current market risk in using traded bonds, because some of the financial advisors or whoever, they may advise you to include publicly traded bonds like a treasury or whatever in your portfolios. You need to realize that if interest rate rise, as it has been rising, the value of your bond drops. That's a nagging loss for your portfolio. But we'll talk about that. And then using derivatives for hedging and using non-correlated assets. Allow me to go over them rather fast. So diversification is a key. Well, Warren Buffett may not agree with you, but for you or for us as a typical investors, with not much of deep pockets, you may have very deep pockets, not me, I have to be careful. I have to look to diversify my portfolio to have a solid gain. I have illustrated 2 scenarios. On investment A, you have $100,000 invested for 25 years. You seek to diversify in 5 different types of assets. The first asset that you invested $20,000 resulted 0. You lost all of your money. Another $20,000 that you invested did not gain you any return, 0% return. So you only have your initial principal of $20,000. Your third bucket of $20,000 generated 5%. Therefore, after 25 years, you accumulated $67,725. Let's consider that we all invest for long term. That means let's distinguish between investing and trading. Yes, if you wish, you can be a speculator, but don't call it investing. You could be trader, which is nothing wrong with that, but do not compare and contrast your performance with investing. So when we talk about investing, we talk about low frequency trading, per se, if you wish, that you have long-term horizons. So another 20,000 of that 100,000 investment capital available for you, within 25 years, if you have gained 10%, would have resulted 216,694. And your last bucket of 20,000, lucky you, generated 15% normal return. Don't look back. Past year or so has been crazy. But nevertheless, if the history is a good evidence of what would happen in the future, on average, it will all regress to mean. So that means that you may have 658,000. Altogether, after 25 years, your investment of 100,000 in 5 different diversified assets would result 962,800. On the other hand, if you take conservative approach and you invest 100,000 is something that gives you 6%, well, you only will get 429,000. Sometimes you take a high risk when you play it safe. that should illustrate diversification is a key or could be utilized as an important tool for protecting your portfolio. I want to present you briefly one of my funds or one of the portfolios I manage. This is, basically, I look to maximize my growth and the capital appreciation, average of 43% return since 2016. And the idea is that my investment policies that I look at for macro trends and identify those long-term trends that will have a decisive impact in overall consumptions, business investment, and government purchases, all part of my GDP. I identify market leaders for each industry. And then looking at business analysis and valuation, I select the best stock. Or in other words, if I've identified 5 or 10 leaders within those industry, within those 5 or 10, I conduct my business analysis and valuation to figure out the best of the best. And then I use technical analysis to identify the right time to buy. So my method is a techno-fundamental analysis. And of course, I monitor my performance just to make and also in order to reduce the volatility of my portfolio, I focus on large cap companies, companies which they have minimum of market capitalization of $10 billion. Simply said, take the outstanding shares of a company times the market price, that would give you market cap of the company. So I look for market capitalization with long-term growth, so I will minimize the volatility. And my portfolio has basically mainly US-based large cap that which they have high trading volume and therefore will not cause any kind of mispricing. And also I want to make sure I focus on US-based companies for the accuracy of their financial reporting. And more important, my fund does not have any leverage, it's all based on cash. Looking at that, my geometric return basically has been 43%. Compared to S&P 500, which is indicated by Vanguard 500 index, 15%. I've been able to achieve this high performance primarily by diversifying and, more important, selecting right assets. And guess what? My volatility, look at here, my downside rider deviation is less than market. Maximum drawdown I had 17%, market had 20%. My beta is a measure of volatility compared to market, is only 107. Market is 1. So if the beta of your portfolio or stock says 1.2, that means your stock is 20% more volatile than market. But my beta is 107, almost the same as market. My alpha, the excess return compared to market is 22%. How and why? All based on diversification and making sure I'm able to utilize maximum performance. And of course, according to Morgan style, equity style box, my portfolio has 62% on large cap, 52%, 15% at the large cap blend, and 11% mid cap blend. These are the sectors I have focused on. As I said, more than 98% of my holdings are US based, as only less than that is about 1.26% or so, international equities. Then I have my 20% or 20.6% in discretionary, consumer discretionaries, 49% or so in information technology, 13% in communication services, consumer staples 6%, and financials 9.73%. Looking at my balance, if somebody invested in me in January 2016, 10,000 as an example, today you would have had 20,515 if you have invested in market. and with me that has 63,680. And this graph basically shows my diversified portfolio compared to market. Again, the message here is by diversification, I utilize better alpha, I create better performance, I minimize my risk. Another method for basically protecting your portfolio is using derivatives. Derivatives are simply said, they are contracts, financial contracts or financial instruments, which their price depends on the underlying instruments they use or underlying asset they use. You can use something like put options to protect the downside move on your portfolio. And if you want to be more, sophisticated, you can also use call options as an exit strategy. I use, for example, put options as an entry level to buy a stock. So derivatives is another method. I don't want to make it too technical, and therefore I want to give some room. If anybody's more interested, please feel free to ask me questions in the Q&A so I can elaborate more. However, another important tool to diversify your investment or protect your portfolio is invest in non-correlated assets. Non-correlated assets are those assets which doesn't matter what happens in the marketplace. Their price do not change. The coefficient correlation is simply zero between what those assets and market. And some of them are non-traded. That means in reality, it doesn't matter what happens in the marketplace, the value of your price, the value and the price of your asset does not change. What are some of the examples of non-correlated assets? Let's look at REITs, the real estate investment trusts, for example, emerging market bonds, gold and other precious metals. Here are also some of the most common non-correlated assets: commodities, municipal bonds, art collection that is, and wine. Another way also, alternative investments also offer a wonderful and efficient way to invest in non-correlated assets. These alternative investments, not only are non-correlated assets, they could generate income for you, especially in the times of lack of visibility for the market. You are not sure how market will turn out next 2 years. There are so many conflicting variables coming into the play. It's very difficult for you to decipher a proper direction for your market. It's not a bad idea to park some of your money into alternative investments, especially those who generate steady income. Your principal is preserved, but nevertheless, you get your annual income distributed monthly. But you have to, of course, appreciate the potential and the risk of each investment you do, like as everything else and as always. One of the main problems with the non-correlated assets, specifically alternative investment, is the liquidity. If you invest, say, $100,000 in an alternative investment, if you want to have it back next year, if you have invested with 5-year maturity, as an example, if you decide to withdraw next year, you can do it, but you have to pay penalty. So typically, depending on what you invest, typically it's a great idea to stay there 2 years, so the interest you earn is much, much greater than penalty you pay. And for that, you can utilize a laddering strategy to minimize your liquidity risk. Here's an example, just to provide you a couple of examples. by the way, these alternative investment I have presented here, please, again, as I have said earlier, do not take it as an advice. If you are interested, please get in touch with me and I will provide you more detailed information. I'm just presenting here as an illustration, as an examples. But nevertheless, I do due diligence. I go and meet with the CEOs and CFOs. Indeed, I'm going to Dallas, Texas. Again, another meeting I constantly have with their CFOs and CEOs just to understand more their business model and to make sure I hedge my risk because we invest a large amount. I have more than $950 million under my management. So therefore, not only have equity portfolio, this is my equity, and I do have fixed income security, which mostly I invest in these alternative investments. Therefore, I do have high responsibility to conduct my due diligence. And my team helps me very much. But nevertheless, as an example, if you invest in GWG covered bonds, in 2 years, you will get 5.5%, and 3 years, 6.25%, 5 years, 7.5%, and 7 years, 8.5%. Mind you that your principal is preserved, and therefore you will be, receiving annual interest distributed monthly directly in your bank account. So for 100,000, this is just illustration. So if you invest in 5 years, you will get $625 per month and $7,500, for example. Or if you invest in Red Oak, is a commercial lender that in 5 years pays 7.5% and interest is distributed quarterly. Or in Cottonwood Properties, which basically is a preferred stock, you get 5.5%. Just as examples for indication of different alternative investment that you may consider for your portfolio. So this is just a quick information for me. I know I'm going over my time limit, and I will be very happy to entertain any questions that you may have. I hope I did not, pass my limit of time too much. I'm open and delighted to entertain your questions.
First, Mr. Gandevani, I want to thank you, obviously, for a great presentation, and we're going to ask that you come back again. I do want to also introduce Mrs. Tehrani, who is the chair of the events committee, who will arrange that with you as well. I didn't mention her in the beginning, but we have more viewers now, so it's much better. So more people heard, the better for you. But I really want to thank you. At this time, we're going to have whoever would like to ask a question, raise hand, and then someone from IAS will unmute you so you can ask your question. Mr. Mani, I believe you have your hand raised, so you'll go.
Yes, thank you very much for joining us tonight. It was very informative and very much appreciated. My question, Dr. Gandevani, is just before you come on call, Chairman Powell was on 60 Minutes, and he gave a very positive view of what's happening in the next couple of years. First of all, as you said, he said that he doesn't expect the interest rate goes up. He believed with so much money in the market, including $4 trillion that during COVID has been released, and President Biden infrastructure and low unemployment is expected to rapidly go lower. He expects a lot of money goes to the market, and naturally when it goes to market goes up. Now the question is, he also emphasized that they're not really concerned about individual stock, but they're more concerned about the market resilience. So my question is, many of these stocks that you mentioned, I've read it before, and there are some has a high risk. What do you think the stock market obviously want to react to Chairman Powell? Because usually when he speaks, everybody listens.
Absolutely. Chairman Powell has been reassuring market for the past several years, specifically after pandemic, constantly with the prior Secretary of Treasury and currently with the current one. I'm not sure if he can do anything else. So the message market has achieved from his talks is that they know for sure Chairman Powell will keep the interest rate low. But that overnight Fed interest rate, that is different from real interest rate. For example, go ahead and apply for a mortgage. Right now it's about 3.5%, 4%. But does everyone is able to get that mortgage? Go ahead and apply for refinancing. Go ahead and buy a car. If you have good FICO score, yes, you get relatively low. But in reality, when you see more than 65% of borrowers that are paying 3 to 4% above the prime, that means the real interest, when I say real, I don't mean real, because I don't want to confuse with nominal. But what people are really paying interest is different what being printed in terms of the overnight Fed. Overnight Fed is when major banks, they borrow from each other. And for whatever reason, if they don't have proper credit worthiness, they have to go directly to the Fed and they get discount rate, or they call it graveyard rate. And then because of this negative connotation with that, simply Fed had decided that now the discount window rate is the same as overnight. So yes, we do have Fed, Fed assurance. Yes, and that's the reason that market likes it. But on the other hand, the market could turn around as we did several weeks ago, about a month and a half ago. Market didn't like it. So we surpassed 1.5% despite constant assurances we get from Chairman Powell. So on the other hand, I want to take advantage of that. If the interest rate is low and there is a amazing or really large liquidity coming to market, as an investor, I like it very, very much. There is that's the easy money to make. However, be careful. That's what I'm saying. Make sure you invest in good stocks and make sure you utilize proper methods to hedge your portfolio. Mr. Sanai, Mr. Mani, I'm sorry. I hope I was able to.
Yes, thank you.
Yes.
Thank you very much. Yes, thank you.
Absolutely.
Next question. Anyone else have a question?
Yep.
Go ahead, Mr. Khosrowshahi.
Can you hear me? You hear me, right?
Yes, very well.
Okay. Dr. Gandevani, I have two questions. One is in relation to the market volatility, or actually a particular investment volatility. You mentioned about the beta. What is the range of safe beta in one particular investment?
So there are two general measures for us to understand and measure riskiness of an investment. One is, we call it a standard deviation. Simply said, is the deviation of the average return of that asset. So when you have larger deviation, there means more volatility, more fluctuations, more risky. Another measure that we utilize is beta. Is basically, this is relative stock market risk. We are measuring the volatility of an asset or stock to the general market. In other words, we assume that if we are able to bring all the stocks in one portfolio, like let's call it market portfolio, and we ascribe beta of 1. Therefore, if we measure beta of different stocks, if they're higher than market, we consider them to be more risky, and therefore we are hoping to achieve higher return. Conversely, if the beta of the stocks are less than market, for example, it's 0.8, compared to market one, we expect because of the less volatility, we should have 20% less return than market. However, as you know, they sound very good in theory. The fact of the matter is that beta measurement we use a lot, but it's not really working. That's why we call it a smart beta. We simply said we can identify many stocks which we have created funds. They have less than market beta, but they provide better performance than market. So on the other hand, is an easy way out to measure volatility of a stock to a market. Hopefully I was able to answer your question.
Thank you very much. Now, the second question is related to the real estate. I just wanted to know your opinion. It seems to me the inflation is usually kind to the real estate market rather than the other alternative assets or investment, I should say.
Absolutely. So anytime when we want to hedge or protect ourselves about rising prices, which let's use it as inflation rate, physical assets or real assets are usually better protection because there is limited amount of physical assets available, including real estate. So yes, real estate, if selected carefully, they could be utilized as hedging tool against inflation. On the other hand, if you are not careful, you could face the same correction we had in 2008, or even worse, what do you think the average rate of return on real estate has been? Let's look at single family. Of course, recently after the pandemic, we have seen higher prices, but generally we have been facing about 5%. So if we have average inflation rate of 2.5% to 3%, our gain has been 2% on real gain. What I'm trying to say that, yes, we can use real estate as hedging, but it should be a small amount of our portfolio in real estate.
I see. Okay. Thank you very much. Thank you.
Absolutely, my pleasure.
Any other questions?
If they don't have still, Al, I have question.
Go ahead.
No, I'm sorry, Dr. Gandevani.
Go ahead, Mr. Bhattacharya.
My pleasure.
The name of the game on the market is about the cryptocurrency.
Yes.
And it seems to me, at least, I'm not actually educated in that area, but it's already inflationary phenomenon. So would you comment on that? Not advice, but just a comment. Right.
So cryptocurrency, let's call it crypto asset or digital assets,
right.
They are going to stay and they are here to stay. They will change our life as we know. Meaning that FBI, central banks, sovereign governments, all of them are looking into this method of assets for several reasons, for better protection, for faster transactions, for less cost. So there is no doubt about that. Blockchain as the primary protocol of this digital asset is playing important role in our current and future. Of course, blockchain is relatively old. We have better protocol like Ethereum that utilizes smart contract, and hopefully maybe another time we'll discuss about the whole digital currency and what does it mean, blockchain and everything else. So from the speculation perspective, yes, why not? If you want to be a trader, why not? You can directly invest in Bitcoin. Well, you can directly invest in Bitcoin, or you can directly invest in ETFs. For example, Fidelity is putting together an ETF, or a strategic growth. We have, for example, GBTC. There's another, ETF. So there are ways for us to invest and participate. in this cryptocurrency, high, as long as you can weather the volatility, as long as you can appreciate that today is 61,000, tomorrow could go 40,000. Are you okay with that? If you're okay and you realize this is not investing, this is trading, this is a speculation, call it gambling, call it whatever you wish. So that you have to distinguish clearly. Investing per se in cryptocurrency, any form of that, compared to investing for long term. So there are ways you can participate, but if you do so, please do not allocate too much of money, and please understand that you may lose all together, and if you are okay with that, God bless you, why not?
Who regulates, by the way, this?
So the regulation is that SEC is trying to come ahead, but problem is that SEC is late to the game already. There are other governments who have regulated these digital assets, but nevertheless, if something is provided to public as an investment, then SEC has come and will come. For that matter, SEC has been, has approved several ETFs, but with this understanding that you are taking a big chance. I want you to understand, I'm just so hesitant to really elaborate on that more than this. But yes, as long as you could appreciate your risk and as long as any investment is offered to public, SEC is on top of it.
Thank you very much. And I hope the next meeting will be in person. Then at least we have a pleasure of, meeting in person and seeing again. Thank you.
Indeed, that would be my pleasure.
Thank you.
Any other questions? Anyone? I just have one more thing to add, Dr. Gandevani. With Zoom making life so easy, even though we would love to meet you in person, this is very efficient, effective, and I think it really works and has changed the world. There's some good that's come from this pandemic. So if there are no further questions, go ahead, go ahead. I thought if there's no other questions, Dr. Gandevani, this was a wonderful presentation. On behalf of the Board of Directors of the Iranian American Society of New York, we greatly appreciate it. Obviously, it was very educational. Obviously, what Dr. Gandevani says as a disclaimer has nothing to do with the work that we do with the Iranian American Society of New York. And as he said, it's not, it's not financial advice, but if you need to contact Dr. Gandevani individually, everyone is free to do so. We found it very helpful, and we're going to certainly ask either to see you in person or to have another one of these virtual events in the very near future. Thank you so much.
Absolutely, my pleasure. I want to express my gratitude again one more time. And Mr. Hidayati, I always believe there is a blessing, anything that we encounter. Indeed, unfortunately, with a lot of pain that we endured going through this pandemic. But one of the amazing, byproduct of this pandemic has been accelerating the technology development, including this, amazing, efficient tool. And nevertheless, one more time, I wish to thank, of course, Mr. Hidayati and Mr. Khosrowshahi and their amazing team, and I guess Mrs. Vida Tehrani. And please forgive me if I do not remember any other ones, but thank you for this opportunity. Wish you all the best. And
if you give Dr. Gandevani, my apologies to interrupt you. I believe someone has their hand up. I'm just trying to get them to ask their question. If you don't mind, my apologies.
Absolutely.
Hello?
Yes, go ahead.
Yes, sorry about just my apologies for the late question. Just a quick question for the gentleman. It's regarding the investing philosophy of growth versus value. I noticed that your own fund, you are very focused on. It seemed like you were very focused on growth, and so I'm guessing that's your preferred investment philosophy. But if you would be so kind to elaborate a little bit on growth versus value, I know like Benjamin Graham and his student, obviously Warren Buffett, are emphasize value investing, and on the other side there's the Fisher father and son, from founders of Fisher Investment. They focused on growth investing. What's your take on this, and how do you compare them? Thank you.
Absolutely, my pleasure. Indeed, investing anything, I mean, the whole idea of investment is buy low, sell high. The problem is that sometimes you do not know if you buy low, it will go lower or it will go higher. You hope it will go higher. Therefore, when you are doing value investing, for example, you can use different metrics, including PE. You are looking for relatively low PE, right? So you are paying less dollar for the projected earnings in the future. But on the other hand, it seems that sometimes when you pay low, you may get lower. And that's, think about it. If companies having some financial problems, market doesn't like it, they don't pay a high price for their stock, the stock price is going down, quote unquote, offering a value investment. And you buy, keeps on going lower and lower, filing for bankruptcy. On the other hand, when we look at the performance of value stock for the 10 years, has not doing well at all. Just recently, in the past 6 months, we saw a little uprise, but not much of difference. Growth stock, on the other hand, you don't mind to buy low and sell higher, but you end up buying high and selling higher. So growth stock, as the name implies, has more potential, better return, but naturally risky. For my own fund, to minimize the risk, I focus on large cap, established companies, US-based companies, so I can reduce volatility inherent in growth projected companies. So I would say, depending on your age, depending on your time horizon, depending on your capital for investment, depending on your personality, these are the risk factors that could basically comprise a risk tolerance index. Looking at those factors, then you will say, you know what, based on my risk tolerance index, I prefer to go to low vol or low volatility stocks. Then you may go ahead and have a blend, or maybe go more dominant toward value. On the other hand, if your risk tolerance index is moderate toward aggressive, maybe growth stocks would provide you better performance. I hope it was helpful.
Yes, thank you.
My pleasure.
If there are no further questions, I'd like to once again thank you, Dr. Gandevani. Clearly, we're going to need you again. It was a wonderful meeting. Thank you, Mr. Khosrowshahi, for the introduction to Dr. Gandevani.
Thank you.
Thank you, Mrs. Tehrani. Thank you, everyone on the board of directors, and obviously our guest of honor, Dr. Gandevani. Have a great evening, everyone.
Thank you.
Thank you.
Bye-bye.
Good night.
Good night. Khuda Hafiz.
Hold up.